Welcome to the Balancing Act podcast with Singer Liwak. In this episode, we're joined by Sheila Balzer, leader of our credit union client service group, Adrian Hyatt-Ward, president and CEO of Hyatt-Ward Advertising, who works with credit unions across the country, and Pam Easley, an executive management consultant with decades of experience in credit union leadership. Together, they'll explore key trends at the management, board, and supervisory committee levels. Topics include economic pressures, credit risk, cybersecurity, fraud, growth strategies, member service, and how credit unions can stay resilient and responsive in today's evolving environment. Let's get started.
Today we have three professionals from the credit union industry who represent three different perspectives of some of the issues, insights, and some of the impacts that credit unions are going through during this time. I'll turn over to our first person. Her name is Sheila Balzer. Sheila, would you like to introduce yourself to everyone listening today?
Sure. Thank you, Pam. Again, my name is Sheila Balzer. I am an assurance partner in charge of our credit union service group at Singer Liwak, a large public accounting firm in the top 100 firms. I have been serving credit unions and all of their needs, especially from the audit, compliance, and assurance perspective, for over 3 decades. And my clients exist all over kind of the western half of the United States. So we see a lot of different things, but there's also a lot of common trends that we see throughout the industry.
That's great. Thank you, Sheila, for that quick introduction. Our second person on our panel is quite interesting and has a very interesting background that's extremely complementary to Sheila's, and that is Adrian Hyatt-Ward. Adrian, would you like to give us a quick background on yourself?
Yes, hello there, and thank you, Pam. Hi, Sheila. So I am Adrian Hyatt-Ward. I've been the president and CEO of Hyatt-Ward Advertising for nearly 30 years. We are one of the most successful ad agencies in Southern California and have worked with many well-known brands in a variety of industries, including a number of credit unions across the country. So I'm excited to be here and hopefully lend my hand into giving some information about marketing.
Great. Thanks a lot for that, Adrian. I'd like to introduce myself. My name is Pam Easley, and I'm going to be serving as kind of the moderator for our little discussion today. Like Adrian and Sheila, I have over 30 years experience also in the credit union industry and the banking industry at large. And I was a former Big Four principal as well in the areas of financial services. And I am a former credit union CEO and CUSO CEO. And the first thing that we wanted to talk to are trends. And I'm going to start with you, Sheila, given that you have so many credit union clients. What do you think are the top 2 to 3 things that credit union executives are focusing in on?
Thank you, Pam. This one is kind of an easy question from my perspective in serving credit unions to answer. And the first thing I would say that I see everybody concerned with focusing on, be it management or the volunteers, is how the current economy is impacting the individual credit unions. And that's really specifically looking at an environment of rising and higher delinquencies and other issues that kind of go along with a more turbulent economy. So for those institutions that have commercial loan portfolios, maybe considering loan modifications. But all of that is tied to where it shows up, in the financial statements, and that is through the recognition of credit losses and kind of some of the volatility that people are experiencing. This, as all the people know in my world, the credit unions had to implement CECL guidance a couple of years ago. And so it's still relatively new, but feels a little more volatile to the institutions, but also, implemented in a time where, the interest rates had moved up quite significantly, and the delinquencies are rising. So one of the first things I talk about, or I see people talking about, is the adequacy of their credit loss reserves, and then managing how that impacts their bottom line, because higher reserves, higher expense recognition. And as we know, credit unions can only build equity generally by generating net income. So that's a significant conversation. The second thing that I feel is kind of at top of mind is a little more strategic, and that is basically challenges to various credit union sources of income. And while that might not be immediate, it's definitely something that everybody's talking about. And things like, for example, while the loan rates have gone up and the interest income has gone up, related to that, the cost of attracting and maintaining deposits has also gone up significantly. A lot of challenges around fee income and what can be charged. Discussions around interchange income and whether that's going to change. Also, in an environment where everything just costs more, the people, the benefits, the cost of having their branches. So that is a little bit more of a strategic discussion, but definitely something that everybody is talking about.
Yeah, those are definitely the two hot topics right now that everyone is focusing in on. And Adrian, I'd be really interested on your end. What do you see from your clients as to what they're focusing in on these days?
Well, sure. Thank you, Pam. I think I'll go back maybe a little bit to what Sheila was addressing, because we don't have obviously a personal communication with the board and supervisory committee. What we see on the marketing end is probably just more the reaction of what the company's goals are, and how marketing needs to address those things. But talking about the current economy, I think that what we saw even last year, the last couple of years, with the rates going up, a lot of our clients, stopped marketing a lot. The interest rates were much higher than they were used to being able to offer. And so that did affect challenges to their income. So what we see now, and maybe this is just a shift going into 2025, but we're seeing actually more aggressiveness. Some of our clients coming out with very aggressive rates and incentives, either to bring on new members or even just for retention. So maybe that's kind of a reaction to what they were seeing over the last couple of years, not being able to get new auto loans like they used to, or like Sheila's saying, even if it's in response to credit losses, they need to obviously build that back up to what they were used to doing. So we're seeing, in our standpoint for marketing, maybe more aggressiveness. Aggressiveness kind of going for it, as far as, hey, we're going to throw these offers out there, put together some great incentives to either keep members or bring new members in, and then also product growth with current members. So if people are kind of staying put, not knowing what's going to be happening, with the economy, let's try to grow, our relationship with these members. So I would say, aggressiveness, kind of trying to come out with better rates and incentives, and then product growth with current members would be the things we're seeing.
That's definitely right. And it really goes back to that whole theme we were talking earlier about, which is member service and member experience being at the core of the credit union. And all of this works together for sure. And we've been talking right now in the last few minutes about what's on the minds and the focus of credit union executives and the boards in general. Sheila, I'd be interested from your perspective. What do you think has been the focus of the supervisory committees that you've been dealing with? And maybe you may want to explain for those who are new to the industry kind of what the function of a supervisory committee is.
Sure. Thank you, Pam. So the term supervisory committee refers to the volunteers at the credit union that really serve a function of oversight. And so in a public world, it would most likely be called an audit committee. But this committee is the one that really is tasked, you hear it, with the oversight of the safety and soundness of the credit union themselves. And largely, they do that by hiring the auditors for the credit union or other professionals to help them exercise that oversight on behalf of every member of the credit union. And they're also responsible for kind of making sure that management is responsive to any findings of could be internal audit or opinion auditors and even the regulators. So two core functions is making sure those audit activities are occurring, and the second one being that management is responsive to any findings. So that's really the core purpose of the supervisory committee in the credit union space. I obviously spend a lot of time talking to supervisory committees in my role as an auditor. And one of the things that we talk about a lot, and you'll kind of hear a common theme from me in this, is we do talk a lot about CECL and the adequacy of credit union credit loss reserves. The reason being that is they know it's a significant estimate. And so management is largely charged with that estimate, but they have responsibility to ensure essentially that estimate is a reasonable and supportable number for what the credit union expects to incur in loan losses over the life of their portfolio. So I often say this with supervisory volunteers is, they come from all different backgrounds, right? It could be teachers, it could be a plumber, it could be someone who has an accounting finance background, but a lot of times it isn't. And just like you don't want me helping you, say, renovate your home and the plumbing, or you may not even want me teaching the youth of America, but they are responsible for kind of overseeing something, whether or not they have expertise in that area. So they're really looking to us as the auditors to have good dialogue and inform them, largely, help them understand what they need to understand, and also provide that feedback on management and the process. So that's one of the things that we spend a lot of time with, not only the supervisory committees, but the board, and kind of making sure they have the tools necessary to execute that oversight and deal with this, because the economy is a bit turbulent right now and different things going on, and so all of those can impact the credit union, and so they're looking for us to help make sense of the numbers and how they can look at those and exercise that oversight. So that's one of the things, I think, Pam, especially the supervisory committees. I also see, and this one kind of comes more at the board with like the strategic planning, is a lot of times they're focused on wanting growth at the credit union. And again, that can be defined in a lot of different ways. It could be growth in the total number of members. It could be growth, of the loan portfolio. They could be talking about growth of the overall size of the credit union. And so that's something that also I see being brought up again and again from institution to institution. And so kind of some of that is also about educating everyone about the competitive landscape that credit unions are operating in right now, and that the fact that acquiring that next member or things like that, all of that, it has a cost to doing so. And so making sure the strategies make sense for the credit union. So sometimes I feel like we're involved in those conversations and helping to kind of talk about some of the strategic initiative of the credit unions.
And if you guys are okay, why don't we talk about growth a little bit? I would like to turn to Adrian, who hasn't talked in a little bit. Adrian, from what you're saying, that there were many of your clients have gotten a little bit more aggressive in some of the things that they have gone in on their messaging for retention and other reasons. What have you seen from their intention to grow, and is that different from what you've seen before?
Well, sure. And I think the biggest thing that we're talking about is how to differentiate. And one of the biggest messages I think that resonates with members and the community is just that credit unions are community based. And so what we see is that being a differentiating factor. So as far as growth goes, let's say we do a direct mail piece. We're trying to show here are the nonprofits that we support in the area. We are the community financial institution. Um, and again, even with the current economic situation, I think that resonates because the atmosphere right now is I want to go where I know I'm going to be taken care of. I want to go to a place that understands the community, that's giving back to the community, and really make that tangible. So, and then in response, we've seen huge growth from those types of campaigns. With membership numbers, with direct response that they could, clients come back and say, we know we got 600 new members, from this mailer, because we could track it. We could see who we mailed to, and we could see who's become a new member. So we've kind of taken that and applied it to campaigns that we've done for different clients, just really positioning them in the community as that community partner. So you have to differentiate to grow, because otherwise, why is somebody going to pick you? Over the competition. From the marketing standpoint, I think that's the key element.
And Sheila, I'll turn to you because I know you've had some recent experiences there with some of your clients with their plans to expand more within their own communities and beyond, right?
Right. You really have seen a trend in the credit union world to kind of establishing foundations or very specific plans for their community outreach. And I know you wouldn't expect the auditor to say this, but I'm very proud of some of our clients and the impacts they have had on their communities through credit unions are a driving force for good by providing scholarship to deserving students, and just how a lot of times when a natural disaster strikes, you're seeing the credit unions really step up and helping out the people and their members impacted by that. But so I'm very proud of the industry and the commitment to the people helping people motto. But one of the things that we talk about sometimes with credit unions is kind of formalizing some of that community outreach, either through a foundation or specific plans, so that they have the ability actually to report back to their membership, not only their financial results, but the impact that they've had on the communities that their members, live and work in. And so sometimes that's kind of a fun conversation you wouldn't necessarily think about having with your auditor, but talking about how you can kind of formalize your approach, even to the point where the impact of your outreach can be validated by, say, an auditor or a third party, and providing that information back to your membership, say, as part of your annual meeting. So just another thing that we see some of the credit unions doing, they all do this, but how about formalizing some of it, and so that you can track and really provide that feedback to your membership of the impact you've had, and not just, the net income of the credit union.
That's absolutely right. In fact, I used to use that opportunity of the annual report and the annual meeting to actually focus in more on that than anything else. And with that, Adrian, I know you might have some further insight with regard to what you're seeing from your clients with regard to different types of growth strategies that they have had beyond what you've already talked about. Do you have anything further that you'd like to share?
Yeah, just to kind of go into what you were just mentioning about the annual report, and and like Sheila was talking about, really being able to show it. Just to finish up that note, one of the interesting changes that we've made is, instead of doing an annual report or calling it that, we're now calling it Member and Community Impact Report. So just an FYI, or a tidbit of information. It kind of takes that away from sounding like it's a public entity to more of like, that report to members and what our community impact has been. So that's just something, to wrap up that part of our conversation. But other areas that we see is the digital aspect. Being able to, promote that we have a co-op network or shared branches or different things is good. But now in the digital age, being able to promote that you can, be a member and access your banking anywhere is a benefit. So we see, a bigger push on that as far as being able to really show our online banking or the app, or, we just have a lot of credit unions that are really promoting all the time. Like you said, the security and how we've upped that on our online banking, or, all the benefits and all the things that our apps can do. So that to me is showing a growth strategy and knowing that we can reach further, maybe than we could before, to be able to retain members or even attract members, that to let them know that they can do business with us.
I think that's a terrific tidbit to everybody, because when it comes annual report time, we all look at that and we all want to figure out how do we differentiate ourselves, but also how do we communicate a little bit differently, so that members really know what we're doing. And I think that's really great, Adrian. Thank you for sharing that. That's really a special thing. Sheila, as we're talking about this part of credit risk, which is a little bit different than the CECL calculations in a way, but it does impact the CECL calculations. What's your thought on all of that?
Yeah, thank you, Pam. So with the implementation of CECL, generally, you went from having to record an allowance for losses for a 1-year look forward to the life of the portfolio. So generally what I say is the crystal ball got a little cloudier. It's a little bit harder to predict throughout the life of the portfolio when we see how fast things change in the economy. And so with that, I think there's two important things that credit unions should be considering and doing right now, especially based on information that they obtain and are hearing from members. And the first one is specific to the calculation, in that in this kind of environment, in my opinion, it's very, very important to really do a hard look at what you're adding to your CECL calculation as the environmental factors for both internal and external considerations. Because some of the things that are a little more future looking won't have shown up yet in kind of your charge-offs and recovery history. So looking to see, for example, let's say you're a credit union that has a lot of government employees. Well, you need to be kind of thinking about everything that's going on in that space and how that might impact your loan portfolio performance, or if you have issues with real estate values somewhere. All of those things, I think this is when it's really important to look at that kind of environmental factors, and not just kind of do a phone in, hey, we added 10 basis points to everything and call it good. So, and I do think, as Pam mentioned, sometimes outside perspective on that does help. And in fact, really, you should have your CECL models validated periodically. That's in regulatory guidance. It doesn't spell out how frequently it has to be done, but that also is something that's there to give you kind of that additional perspective on what you're doing. And then the other part kind of along that is for those credit unions that have significant commercial portfolios, I do think you really need to be deciding if there's unique risks or exposure within that. For example, let's say your portfolio has a bunch of hotels, and there's predictions that, travel spending is going to go down with the economy or something like that. Those are the kinds of things that I think you need to really dive in and look at. And then lastly, what I'd say is this, we're about 2.5 years out from when CECL was implemented. And so everybody made a decision at the outset as to what methods they were going to use. And now you're, 2.5 years out. So it's time to go back and kind of do some back testing and see, were the methods that you chose for your institution actually good predictors of your loss history, and decide whether or not maybe it's appropriate to choose a different method. So I think those are kind of things that we're talking about or having dialogue with the credit unions, given the time frame we're in. So with the economy being like this, I think that third piece of the calculation where you look at the overall environment becomes more important. And then also kind of going back and seeing, is what you have in place really being a good predictor.
Exactly. I would agree with you 100%, Sheila. And I would say, what do you think about this thought? I would add geographic difference, because I can recall once when I had our calculation looked at, and the third party came back and treated all of the different markets that we were in the same. And when you looked at all the different markets that our credit union was in, which I think at the time was 11 plus markets, every single one of those were different. And so that definitely would impact how you look at a potential outcome in your total calculation. Am I off on that?
No, I think that's definitely true, Pam, because a lot of models that credit unions have chosen are softwares that they use to help estimate their CECL reserves.
Right.
That bakes in a lot of data. So one, I think you need to understand what all is in there and what's changing that. And then I think you need to step back and say, what could be unique or different about my credit union? And that could be geography, it could be industry, concentration in, commercial portfolios. It could be, for example, one of my clients, there was a recent strike of their employees, and while it wasn't long, it was a week and a half, that that's going to show up and have an impact somewhere. So you have to kind of understand what's in your model, and then understand what makes you unique and should be considered. And again, I think sometimes that third party perspective helps. And it shouldn't just be about, I uploaded my data to the third party, it spit this out, we recorded that, and we're done. You have to step back and think about those unique considerations and whether the amount is reasonable based on what's going on with your credit union.
Absolutely. And I would think what we're really saying to everybody is that it goes beyond just being a calculation, so you can check the box that you've performed it. We've been talking and spending a lot of time on credit risk, and there's more areas, I think, within our space. I'm going to switch gears here. So outside of credit risk, let's all talk about what other areas might be important to focus on now during this kind of environment that we're in economically. Adrian, I'll turn to you first, and then I'll go second, and then we'll leave Sheila with her wisdom on the third part of this question. Adrian, do you see anything with regard to other issues that credit unions are focusing in on, maybe in changing their strategy, or how it might get reflected in marketing?
Yes, I just feel overall, and when there's any time of, within the economy or anything going on in the world, people tend to go with what they're comfortable with. Mm-hmm. So I just feel like, again, what we're seeing, yes, there's some aggressive rates, incentives, but it still kind of comes back to, we know you and we're here for you as far as the membership. So just continuing along the path of that type of communication, the personal service, the personal aspect. I mean, I know, again, to differentiate, here I bring up that word again. There's discussion about AI versus personal service. yes, we want to embrace AI, and there's a lot of, talk about that. And we have clients that are, that are bringing in different things for, call centers and so on and so forth. But to still kind of come back to, we get our members and we're here for you. Again, that people helping people philosophy, I think, is what we really need right now to just all come together, behind that type of a message. Because I feel like that really is what's resonating.
I do think when you talk about strategy and looking at the future, I think some of these technologies and fintech and partnerships are things that everybody's looking at and considering. So I definitely echo, whenever you're going to do something with a third party, looking at that due diligence, especially someone who's going to have access to your member information. So I definitely agree with all of that. And maybe that is part of a bigger overall enterprise risk management program at your institution. So I think, spending time on that makes sense. And also, from the future and the strategic things, another thing that I think is coming up that we haven't really mentioned, but also, a lot of people look at merger opportunities as a way to achieve some of those strategic growth goals. And again, that's comes with its own set of things you should do from a due diligence perspective as well, in looking if you should combine, your organization with another organization. And I think that's continuing to pick up in the credit union space, just because of all of these other things. It takes money and people to manage and oversee. And so sometimes some institutions are finding that challenging with the resources that they have. So I would add that to the list of what I think is people are top of mind or thinking about.
What about fraud? I think with all of this, we've also seen an uptick in fraud, certainly on the cyber side and IT, but have you seen that out at some of the clients as being an area of concern?
Well, and thank you, Pam, for giving me all of the negative topics. I get to talk about credit losses, and now you just pitched me fraud. So thank you. Don't I sound like a ray of sunshine? So unfortunately, another kind of offshoot of the economic uncertainty going on and kind of geopolitics and all kinds of things is a significant increase in fraud, especially kind of from the outside level or the member level. And it could be, even today we've seen more check fraud. It could be, a ton of plastic card fraud, and account takeover frauds are becoming more and more sophisticated and hard to pick out and to target members of all institutions, including credit unions. So yes, that is very top of mind, and having the programs and monitoring in place to try to minimize that, because that really prevents, even though the credit union, the member might fall for the fraud, what can the credit union do to help the member, whether it's education or having the right controls in place, because having a lot of fraud within your membership is really a reputational risk for the institution. So unfortunately, we're seeing rises in all of that activity and increases in the sophistication of it. And again, I think it's hard because it's, the credit union employees get constant training and tests to make sure that they know not to click links or things like that. But something could happen with any one of your members that you don't necessarily have control over. So I think it's another opportunity for credit unions to serve their members by stepping in and providing education and things like that. And, I think that's important, because again, that is what the function of the credit union is to serve their community.
Adrian, did you have anything to add on that with regard to educating the members of anything that you're seeing from your perspective?
Well, no, I just, everything that you're saying is what we see,
Right.
and back to, like, we were talking about financial literacy and financial education, and and being there for our membership. Like you said, anything like that that we can promote, because that is why we're here, like you're saying. And back to even the discussion about marketing and annual reports and things like that. It's like we're member owned.
Mhm.
So any of that, like you're saying, that from the supervisory committee level and understanding that being volunteers rather than, somebody for profit, all of that, I think, factors into how we market and the message that we want to convey.
Exactly, and that really goes into the topic of monitoring and tracking from different perspectives. And then Sheila, from a credit risk monitoring perspective, do you want to add anything more there of maybe some education or maybe some best practices there of monitoring?
Yeah, I think, and I'll be succinct here, from the volunteer perspective, the boards and the supervisory committees, I think some education around the credit loss function and how that impacts the financial statements. And then I think for management, we kind of talked about what you should be doing is kind of looking at the back testing and model validation, or maybe having a third party in to look at your process and provide feedback. So I think those are all key things. Yep.
Absolutely. So, Adrian, what do you think should be like the top thing everyone should focus in on?
Right now for marketing, again, just that your community, that you are the local financial institution, and that you're here for whatever's going to happen.
Absolutely. And Sheila, what's your thought on the top thing that they should be focused in on?
I think gaining some outside perspective, giving the complexity of what's going on as it relates to your CECL modeling, and for the volunteers, making sure that you have someone that you're comfortable with that helps you navigate that process as well.
Thank you again, everybody, for listening, and we'll talk real soon. Bye-bye.
Thank you for joining us on today's episode of the Balancing Act podcast with Singer Liwak. In today's conversation, we explored the top priorities facing credit union leaders, including how they're navigating economic uncertainty, managing credit risk, addressing cybersecurity and fraud, and responding to evolving member needs. We hope you found these insights valuable. Be sure to subscribe and stay tuned for future episodes as we continue the conversation on the trends shaping the credit union industry. Until next time, stay balanced.